Okay, hey everybody. I'm going to go over Intro to Accounting a little bit. This is Chapter 1, so this is pretty basic stuff, but just kind of wanted to talk on some of the highlights of the chapter. We'll just kind of go over some stuff that you're really going to need to know because a lot of Chapter 1 is really going to lead into what we're going to be doing the rest of the semester. This way, we're really going to go over the accounting equation. That's pretty much what all the reading was about. We'll touch some definitions, we'll do some examples, but the big thing is the accounting equation. That's what this entire chapter was about, like I said. It's something you're really going to need to know. And the basic accounting equation is just going to be this right here. Assets equals liabilities plus owner's equity. We'll define each of those terms a little bit, but the big thing to know is this equation is never going to change. Anytime you have assets, it's always going to equal liabilities plus owner's equity. So both sides of the accounting equation, the assets is one, then the liabilities plus owner equity is going to be the other side of it. They always have to equal each other no matter what. So anytime you make changes to one side, you're going to end up making changes to the other side. But let's kind of break it down a little bit. That first term, assets. What an asset is, those are the things that we own, the things that have value. So the book defines it as anything tangible or intangible that can be owned or controlled to produce value that is held by a company to produce a positive economic value. So basically, it's an economic resource. It's things that we're using to make money. Examples are going to be cash. Obviously, you can use cash a lot. Land, buildings, equipment, inventory, account receivable. There's a lot of different examples of assets. A lot of times it's going to include cars, buildings, cash, lands, things that the business might own that are going to have value. So all of these things have value. They're going to help us make money in the business. Liabilities was the next thing, and liabilities are the things that we owe. So assets are what we own, liabilities are what we owe. So they're two opposite things. Who do we owe them to? We owe them to creditors. So the liabilities definition is going to be obligations of the company, amounts owed to creditors for a past transaction that usually have the words payable. When you're inputting it into your ledger, your journal, which we're going to touch on in the following chapters, you're going to see the word payable a lot. That's the ding, ding, ding. That's how you know it's going to be a liability. So that's what it's going to have in their account title. Like we said, basically liabilities are monies we owe for assets we're gaining. So we're paying for something that we're getting in return. So like I said, payable is going to be in a lot of those things. Examples of liabilities are going to be accounts payable, salaries payable, interest payable, all that stuff. So let's say we're going to take out a bank loan to buy our building that we're putting a company into. That loan payment or that mortgage, that's going to be a liability. Another example could be, say we own a pizza shop. We need to buy some tables and chairs for that pizza shop. If we buy those tables and chairs, we're going to owe money on them. So we're going to have that money that we owe is going to be a liability. We owe it to somebody because we bought those tables and chairs. If we're running a pizza shop, we're also going to need supplies. We're going to need flour, some tomatoes for the sauce, toppings, soda machine, all that stuff, all those ingredients. We're going to owe money to the suppliers who get those for us. So we owe them a liability, so it's going to negatively affect the value of our company. Not necessarily the value of our company, but it's going to negatively affect the bank account of our company. Owner's equity is that last part. Basically, that is the value of your company. It's what your company's worth. Owner's equity is going to be the worth of our business after we subtract what we owe from our assets. So basically, the owner equity is going to be calculated as assets minus liabilities equals owner's equity. It's kind of called the book value of the company in some places because it's what your company's worth. If I was to look at your company and say, hey, how much do I value that company at? Well, just the tangible and intangible things that I can see that is going to add value or subtract value, that's going to be your owner's equity. So some examples of liability: common stock, preferred stock, retained earnings. It's going to be those things that really show how profitable or not profitable your company is. So owner's equity is going to be a term used when a company is a sole proprietorship. If you have a company as a corporation, it's going to be stockholders' equity. There are a couple different names for this one. But right now we're talking about a sole proprietorship, so one person owns that company. It's going to be owner's equity. So let's go through some examples here. Let's go back to that brand new business. We're owning a pizza shop. We're starting a brand new business. And as we get going, we know we're going to need some money. So the owner's going to invest in that company. So let's say I'm the owner. I put $3,000 into that business. If we do this, our business is going to have $3,000 in cash, which is an asset. So assets are going to increase by $3,000. And then because we just put it in, we haven't purchased anything yet. It's a brand new business. We owe $0. Liabilities going to stay zero. And the worth of the business is going to be $3,000. This is a simple example, but it shows we added $3,000 in cash to our business, so it's going to affect our owner's equity. Our business is going to go up. So you can see that both sides of that accounting equation are still going to equal. Like I said, that's a really simple example of owners investing in a brand new business. As our business grows, though, maybe we want to start delivering the pizza. So we're going to need a delivery car, delivery van. There's going to be a number of different ways we can get this van. Let's just say I, as the owner, have a $25,000 van that I already own. I'm going to donate that to my business. So if I already own the van, then it's an asset we own. So it has a value. It increases our equity in the business. If we increase the assets, it's also going to increase the equity. So I have that $25,000 van. That $25,000 van is going to increase our assets because I own it. We don't owe any money on it. It's just increasing the value of our business. So on that other side, it's going to increase the owner's equity. So you're increasing both sides of the equation. Still, if you look at the bottom, it's going to equal each other. Most of the time, nobody's just going to donate a van to you. You're going to have to find some other ways. But this is just, like I said, basic example. If we do it another way, say the more common way, we need a van. Nobody's donating it to the business. We need to take out a loan to buy one. So let's look at this example. We're having to purchase a van through the loan. So let's say we take out a $10,000 loan and pay for the rest without the loan. Then we increase the asset by $25,000 because that's still the value of the van. Because we're still getting the van, it's increasing the assets. Liabilities, we took that $10,000 loan, so that's what we're going to do in liabilities. And then owner's equity is going to be the rest of it because that's what keeps the accounting equation separate. That's going to be the worth of our business after the transaction. We're gaining $25,000, but we're losing $10,000 of it because we took it out in a loan. We still have to pay that back. Our business increases by $15,000. After every transaction, that liabilities plus owner equity has to equal assets. So this is the basic accounting equation, something that we're going to be revisiting again and again and again, like I said, all the way through the semester, so it's something you really got to know. We're also going to use this equation when the business is profitable, so the owner can take home money. That's the entire point of having a business, is so that the owners can take home some money. You want to make a profit so you can pay the bills, provide for your family, buy a house, buy a boat, go on vacation, get groceries. I mean, that's the whole reason you started the business. So we want to buy these things with the income that the business is generating. And if we do that, we take that out through what's called drawing. So let's say you own the pizza shop. You had a good month, you had profits, and you're going to take some money out for some personal use. You're going to take your family on a quick little vacation. So it's completely legal. That's what you're supposed to do. You're supposed to take money out of the company if it's profitable. And that's the whole point of owning the business. So let's say you're going to take out $2,000 out of the business. You're going to subtract $2,000 out of the assets because you're taking out cash. It's got to affect something on the other side of the accounting equation. Well, you don't owe anything for the money, so it's not going to be a liability. But it's going to decrease the value of your business by $2,000 because the $2,000 is no longer in your business's bank account. You've taken it out for that personal use, and again, you drew it. That's what it's called. Sometimes it's called a withdraw, but it's going to decrease the value of your business because you don't have that cash anymore. So you got to negatively affect both the assets and the owner's equity. Like I said, if you had a good year, you're profitable, that's no big deal. We're also going to have some expenses in the business that's going to impact the equation. And we'll also have some revenue, which is what we just talked about. You had a good year. So like I said, we had a good month. We got to take some money out for personal use. But where is that money that we took out? We got to put it into the equation. So when you have a revenue, that's increasing both. So let's check out the equation here. Say we took in $8,000 in sales of pizza. We're adding that to our assets. We took in the $8,000 worth of cash, so it's increasing the assets. This cash is going to increase the assets we have, obviously by $8,000, and it's going to impact our owner's equity through revenue. So a lot of times when you're recording this later on, you're going to write in owner's equity how it's impacting or what happened that made this happen. So this would be a revenue impact of plus $8,000 in the owner's equity category. The increase, the worth of our business, $8,000 because the money we made selling pizzas. But we also have some expenses which are going to negatively impact it. We had to pay the employee wages when we were making the pizzas. We had to pay the light bills. We had to pay taxes. There's a number of different expenses that you're going to pay every single month. So let's just say it was the utilities that we're recording this time. So basically, we had to subtract $300 out of cash to pay the bills and decrease the owner equity by $300 because of that expense. So because we took out cash, owner's equity goes down. Obviously, the business isn't worth that $300 that we no longer have, so we got to take that away. So expenses are just going to be a division of owner's equity, just like revenues, like I said. A lot of times when we record owner's equity, we're recording what it's for. This is going to be an expense account under owner's equity that is going to subtract $300 from our total expense. And the biggest thing I want you to take away, we went some examples. You got to know this accounting equation. Assets equals liabilities plus owner's equity. That's not going to change. It's the basic accounting equation. You need to memorize this. You got to know this moving forward. You always, every single transaction you have to end up with your assets equaling your liabilities plus owner's equity. If something's off, you did something wrong, it's an easy way to check yourself. And like I said, it's something that you need to know. It's something that we're going to look at throughout the semester. But you kind of got a basic knowledge of it now. We'll talk a little bit more about what the assignments are kind of moving forward next time we're in class. But remember this, and if you have any questions, just give me a holler.